Okay. Um, at Bloomberg, we provide multi-asset and broker-neutral trading solutions for clients trading into China across all asset class, including listed equities, futures, options, and as well as OTC derivatives. And our execution management systems can help optimize workflow by consolidating Bloomberg data, news, and analytics into a single workplace. And our offerings cover the full trading cycle from pre-trade to at-trade and to post-trade analytics. So whatever your trading workflow, we have the right trading connectivity solutions and infrastructure support to help you access to onshore market here. In terms of future trading, Bloomberg has deployed a local server in Shanghai. Our clients can actually utilize our local server to increase latency, and all the orders will be processed in our local data center in Shanghai as well. So we have also set up direct fixed connection with most of the onshore OMS used by local brokers, including CTP, RootNet, FIS, and also Hang Seng as well. In terms of trading platform, our platform EMSX allows our clients to seamlessly route single orders and also basket orders to multiple brokers in China. And from risk control perspective, our future trading platform offers pre-trade risk limit settings. It can control the contract list and also pre-trade risk limits at different levels. For example, at user levels, group levels, and a firm level as well. Daily gross and net quantity limits can also be set up through our trading platform. This is a snapshot for our escalator future monitor. So once the pre-trade risk limit is set up, we can proceed to trading. Our escalator future monitor enables trader to quickly identify market trends and profit from a window customized for your own trading style. You can actually monitor market price on the top left and key in quick orders on the top right. You can also set up your own spread metrics at the bottom left and place orders on the chart on the bottom right as well. The escalator here also enables trader to quickly identify market sentiment based on color. As we can see from here, for example, the price bar will show blue if the market is going up. It will show red if market is going south. So traders can directly place, revise, and also cancel orders on this as well. And algos are also available on our trading platforms. One of the mostly used algos for single order is entry and exit conditions. There are actually 3 entry and exit conditions which can be used, including time trigger, target, and also economic release. For time trigger, you can activate or cancel any order at a specific time. For target, you can actually activate or cancel any order when the price or trading volume target is met. For those 2 time and target triggers, they can be used together. For example, activate the order at 9:30 a.m. in the morning and waiting for the ask size to be greater than 300 contracts. That's just an example. And for economic release, the trigger is based on economic release or fundamental report. For example, you can use these below fundamental reports numbers as a trigger to place an order through our trading platform. So another popular algo is synthetic spread. It allows you to create your own customized spread and trade directly through our platform. You can decide how this spread is quoted and how the spread is executed as well. For example, the show checkbox here next to the tickers is used to indicate which leg should be displayed on the order book. And the trader can also specify the maximum size of the slice that is displayed. And if the leg setting control, also we have the leg settings. If the leg setting is set up, it controls how the algo reacts to different scenarios. For example, when the show leg is executed, but the other leg did not fill, and is currently on the order book. So to try to unleg the trade, our algo will go through a two-step process that try to fill the leg together. Next, there are actually two examples. Apart from the two examples we just showed you, we offer also many other algos as well, including schedule-based algos like TWAP, VWAP, volume participation algos like Go Along, VIP, and also we offer price-based algos such as pegging and strike-2. Actually, we'll not go through each one in detail today, but we are happy to do a follow-up demo if you're interested. So apart from trading platforms, we also support multiple workflows. You can actually route orders directly from our platform to onshore brokers by leveraging Bloomberg terminal. But if you have an internal OMS or you onboarded a third-party OMS, but plan to leverage Bloomberg's execution platform as front end, we can also support staging workflow. By staging, we mean that clients can fix stage into our platform from their own OMS or upload predefined orders spreadsheet, or utilize Bloomberg API to generate both orders and placements out to the onshore brokers. So all the workflows here will be local to Shanghai. That means all the orders will be processed in our local data center. Apart from trading platforms, actually we also offer connectivity solutions. So if you prefer to send orders directly from your own OMS or EMS, you can also leverage our local broker network. The connectivity is fully hosted within China. So that means the orders will be placed within China data center and reach those onshore brokers directly. So to have a quick sum up, our integrated platforms gives you the ability to leverage a host of powerful solutions that cover the trading lifecycle from pre-trade to broker execution and order management. So please let us know if you are interested for further demo. We'll do the follow-up after. Thank you very much for your time. Now we'll pass the time to Jack to further demo our trading data and analytics solutions from Bloomberg. Thank you.
Right, thank you, Mark. I hope you can hear me because it's the first time I'm using this this platform. So my name is Jag. I take care of Bloomberg's commodities business in the APAC region in the role of a commodities workflow specialist. What I'm going to be showing you today is really taking you through how Bloomberg can help, especially with the pre-trade side, going through our data, research, and analytics solutions. I've taken a little bit of story of obviously oil in this case. I'm going to try and showcase to you what's been happening in the oil markets, and through that, try and show you what exactly you can be doing on the Bloomberg terminal. All right. I'll share my screen. I think you can see my chart now. So going into this chart that I have here, so I've prepared a few things in advance. We're going to be looking at oil markets together, going through what's happening both on fundamentals as well as on the paper trading side. We kick off, however, looking at some of our virus data on the Bloomberg terminal. So what Mark showed you is part of the Bloomberg terminal solution, which is part of our trading solution. But before you actually place the trade, you will be able to analyze this information on the Bloomberg terminal. In front of you, you have a chart that is helping you track daily virus cases across the globe. So what I have here is a clear depiction of the 3 or 4 waves of the coronavirus that we have seen across the last year or 2 years. As you can see out here, the last wave around the Omicron variant, number of cases are absolutely rising across the globe. It does look like the variant is more infectious than the previous Delta variant. But to be able to look at this and look at cases, look at number of deaths, look at recoveries, the vaccine dosage and the vaccine administration across the globe, you will be able to do this on the Bloomberg terminal. I've used worldwide numbers here. Of course, there are certain areas such as Western Europe where this has impacted. The number of cases are higher than the rest of the world. For example, if I take in Germany, or if I take in, let's take for example Poland, you will be able to see that the last wave has been absolutely more devious, so to say, compared to the last few waves that you've seen. So, number of cases, this is a percentage change. Number of cases in Germany has been very, very high in this wave compared to the last few waves. So to be able to quickly track this information and the impact that it has on the underlying markets, that's where we start off today. So what is the impact that it's really had when we're talking about oil markets? Now, I've taken the INE Shanghai contract, the INE crude oil contract in this case. What you see here is a forward curve depiction of this particular contract. Now, if I look at the contract, on the left-hand side, I have my spot months, my first couple of months, and then I have my long-dated months on the right-hand side of this particular chart. What we see clearly is that the spot months are higher than the forward months. So clearly the curve is still in a backwardated state. What that means is that there is either a supply disruption or a demand uptick in the spot market. There is a convenience premium being placed in the short-term market as compared to the long-term market. However, if I try and compare this to the premium how the premium has moved over the last few days. Now that gets a little bit interesting because the previous chart showed us that the market was still very bullish, but I want to get your attention to the bottom chart here, where the purple line and the red line are two levels showing us how the spread between the first month and the 6-month contract has moved. So I'll repeat that. This yellow line is telling me what is the spread between the first month and the 6-month contract for the INE crude oil contract. Now, when this spread is high, as we saw in middle of November at about 26 CNY, it means that the spot premium on the first month contract is very high compared to the forward premium. However, what we have seen in the last few months, because of the concerns of the variant, because of what's happening in global oil markets, I can do the same analysis with Brent or with TI as well. You'll see a similar story. The spot premium has dissipated. It has gone down, and you're seeing it at about 3 CNY at the moment compared to 26 CNY only about 3.5 weeks ago. So that's one worrying indicator when we're talking about the impact of the current variant on the oil markets. Now, what is actually happening on the actual demand side? So on the fundamental picture, the prices are telling us a story, but we have in-depth research tools where our analysts under Bloomberg NEF, Bloomberg Intelligence, as well as Bloomberg Economics analyze these markets and present to you what is actually going on. So this report came out only day before yesterday, which analyzes airline departures across the globe. And what we have seen, this is a weekly report, what we have seen is that over the last 1 week, there have been 133,000 flights cut as the Omicron virus or the variant flies out or takes off, and there's a clear hit on jet fuel demand that we're seeing, that our analysts are seeing in the numbers around flight departures. Now, we have the underlying data for this as well. So we're able to imply for you here using actual jet fuel schedules, or rather airline schedules, airline departure schedules, what the jet fuel demand will look like across the globe in the next few weeks. Now, I want to get your attention to, let's just look at the global chart here, which is in the blue bars. This is the data reported based on actual jet fuel departure schedules over the next 12 weeks. Now, what you're seeing is that in the next few weeks, sure, there is going to be an increase in the number of flights expected to take off across the globe, and it's a similar trend in different parts of the world. However, what is interesting to see here are these dotted lines. So the dotted lines are telling us what this exact same chart looked like a week, 2 weeks, and 3 weeks ago. Now, because the dotted line is, or the dashed line here is higher than the underlying bars here, it is telling us that a week ago, the market was expecting more departures than it is right now. And that is down to the cancellations that were reported in the previous slide that I showed you as well. So overall, as you can see in the second point here, cancellations last week have removed an average of 133,000 barrels per day of jet fuel demand as compared over the next few weeks as compared to the last few weeks. So analysis like that is readily available for you. Now going into another major driver of what is happening in the oil markets, we're looking at road congestion data here. So we are able to look at Europe, Asia, America's road congestion indicators, and what I have here is at 100% in Europe. That basically tells us what the pre-pandemic road congestion levels were, and then currently what the road congestion levels are as a percentage of that level. Now you have this analysis done for each and every city, but overall, what you're seeing for road traffic in European cities, it has fallen by 7.1 percentage points in the last 1 week, and you'll see that the impact is different for different cities. For example, if you look at something like France or Lyon, the red line is showing us what the last week road congestion is over the entire day, and you're able to see in the gray line, the dotted line, what the same average was 2 years ago in 2019. So, for example, in Paris or Lyon, the impact doesn't seem to be as big. But if I look at, say, Munich, which is taking a brunt of the virus, or Austria, where it's been in lockdown since November 22nd, you're seeing that in Munich, for example, the numbers are quite low compared to where they were in 2019. So there is a clear, demand issue that is taking place across the globe, and it differs city by city, and that's where we can help our clients to be able to tell them how exactly the demand picture is taking off on both the airline side as well as road congestion. This is part of several such reports that we do. We do one for crude oil, we do one for other products as well. There's a petchem report that we do as well. Happy to show that to you on a follow-up demo. So finally, moving into something else that's quite interesting now, moving into the paper market and what is the futures holdings of actual funds in the market. So this is the white line here is showing us what is the positioning of money managers or asset managers for Brent contracts. I can do the same thing for any of the other futures exchanges as well that report this data. And the blue line is telling us the underlying Brent price. So as you can see here, there is a decent correlation between these two indicators. Typically, one follows the other. When the funds start cutting the net positions, you will see prices start falling as well. Now, what's interesting here, and this is where our seasonality tools stand out, the orange line is showing that same number, the fund positioning for how it has moved in 2021. So the positioning of the funds for Brent in 2021. And this shaded area is telling me what the high, average, and low look like in the last 5 years. Now, as you can see with the orange line, this has now crossed the low of the last 5 years. So what this means is that funds, asset managers are at their lowest when it comes to the amount of Brent contracts that they're currently holding on a net basis. So this is basically net position, long minus shorts. So on a net basis, they're currently holding 139,000 contracts, where the average at this time is at about 300,000 contracts. So that's quite telling of a bit of a bearish market. That's something that you can clearly see. But on the options market, there's a little bit of a rosy story that is kicking off. I want to get your attention to this chart here, on the bottom chart specifically, which is measuring the implied volatility of call options minus put options. So the top chart here is telling me, the orange line is telling me what is the implied volatility of the put options. The white line is telling me, or what's the same for the call options. The bottom chart is telling me the difference between the two. So whenever this chart is below 0, which is where my pointer is right now, so below this purple line, it tells me that the puts are more valuable in the market. So people are buying more downside protection so a bit more bearish in the market. And when this chart is above zero, it's telling me that the market's a little bit more bullish. There's more value being placed on call options. However, if I look at this on a historical basis, from the 1st of December, you see that the implied volatility of call options has been increasing. So the net call minus put, even though it's negative, where the puts are higher, the calls seem to be gaining momentum. And this is quite telling because this can be a little bit of a forward-looking indicator in the oil markets. And finally, I'm going to leave you with just one food for thought. Again, looking at the options market, I'm looking at Brent in this case across the entire forward curve. As of yesterday's close, or this morning rather, you see that the maximum volume that is being traded in the options market is for call options. And the call options that we see are between that 80 to 90 range for Feb and March. So Feb, March, June is what we are seeing here. So again, even though the fundamentals at the moment seem to be telling a bit of a bearish story, the options market is looking the other way. You're seeing the call implied volatility going up, as well as people betting on cheap, I would say, cheaper call options that are gaining a lot of volume in the last as of the last close. So with that, I would like to wrap up today's presentation. Thank you for taking a look. This is just a sneak preview into the data analytics and research that the Bloomberg terminal carries. I'm happy to do a follow-up, just as Mark mentioned. Mark and I can speak to you directly on taking you through a little bit more of an in-depth dive into both our pre-trade and our trading solutions. Thank you again for your attention and have a pleasant weekend.